In this video, we will talk about cost volume profit analysis. Okay, now what is this topic about? What we'll look at would be the changes in costs that affect net income and the sales level at which the company will earn an income or a loss. Now, these are some questions that CVP or cost volume profit analysis can answer. What sales volume is needed to earn a target income? And what is the change in income if selling prices decline and sales volume increases? Before we go into details, we need to know the terminologies. So first, the types of costs. First, you have the fixed costs, and these are the costs that don't change along with the number of units that a business produces. So, for example, that will be rent expense, depreciation expense, insurance expense, property taxes, and administrative salaries. So, for example, we can take rent as an example, which can be seen in this next slide. Total monthly rent, let's say, would be 5,000. Regardless of the number of units produced, so units could be, let's say a company produces pens. Now, if a company produces 20 units, it pays 5,000 pesos for rent. But if it produces 100 units or 100 pens, it still pays the same amount. And even though it produces more, the total monthly rent would still be 5,000. However, what would change in this scenario would be the rent cost per unit, or what we call the fixed cost per unit. What will happen is if we actually divide 5,000 by 20 units, we will get the rent cost per unit, which is 250 pesos per unit. Meaning that for every unit produced, for every pen produced, we are consuming about 250 pesos for the rent. And then let's say for this second batch here, 5,000 divided by 100, the rent cost per unit will be 50 pesos per unit. And for the 500 units produced, that will be 5,000 divided by 500 units. Then we will get 10 pesos per unit. Meaning, for every pen produced, what will happen is we will incur 10 pesos for the rent. But what you notice here is if you focus on this column, the more units produced, the cheaper it is for the fixed cost per unit or rent cost per unit. But if we look at the total monthly rent, or in this case, this is your total fixed cost, then it will be the same amount regardless of the number of units produced or number of pens produced during the period. The second type of cost would be variable costs. In contrast with the fixed costs, variable costs would change along with the number of units produced in a period. So that will mean, let's say, in terms of raw materials, direct labor, or commissions. So one example would be, let's say you are assembling a toy. Let's say you are making toy cars. Now, to do that, what you need to do you would have to buy materials to create that toy car. You need small wheels, you need metal, you need glue, and all those things. Obviously, if you need to produce, let's say, 5 cars as compared to 500 cars, then for the 5 cars, you just need less materials compared to producing 500 cars. This can be best illustrated in this next slide. So for variable cost, if you look at the variable cost per unit, it remains fixed, 20 pesos, 20 pesos, 20 pesos. But if we take into consideration the number of units that we need to produce, the total materials cost, or what you call total variable cost, would also increase along with the increase of the total number of units. So in this case, if let's say we need to make 10 toy cars, then the total variable cost will just be 200. But if we make 30 toy cars, then we need to shell out 600 pesos for the total variable cost. So these values here, they were obtained simply by multiplying the materials cost per unit times the number of units. We get total materials cost. So we just do that for each of the rows. We just multiply the number of the cost per unit times the number of units to get the total materials costs or total variable cost. Another type of cost would be the semi-variable cost, or in other textbooks this is called mixed costs. And as the name suggests, it contains a fixed aspect and a variable component. An example with that would be, let's say, a telephone expense. Let's say you pay a monthly telephone expense of 500, and that includes already calling your friends within Metro Manila. But the variable component would be if you call overseas. Let's say you call a friend in New York, then if you call, then you would have to be charged additional fees for that. And if you call your friend, let's say, on a daily basis, what will happen is, on top of the fixed value that you pay for your telephone expense, which is, let's say, your plan already, then the variable component there would increase along with the frequency of your call to your friend in New York. Now, to handle a semi-variable cost, we use the high-low method. So, for example, you are given this table showing the number of units produced by your company and the corresponding cost. So you have the mixed and the mixed component here, mixed costs, containing the fixed and the variable cost. Now, the step one would be, you have to pick the highest units produced and the lowest units produced from the table, regardless of the cost. So what we will do is, we'll pay attention to this column and identify the highest number of units produced, which is this portion in May. And then the lowest will be 7,000, which will be the month of February. Regardless of the cost, whether it's the highest or lowest, we won't pay attention to that. At this point, we will only pay attention to the highest and lowest units produced. Okay. Now, after doing that, after isolating the highest and lowest, we get the difference. So, for the number of units, the difference would be 2,000 pesos. Okay. And the cost here, 5,700 minus 4,700, that will give us 1,000. Okay, now, we have to take note of these two values that we've obtained. This one. Okay, because it will be relevant in the next step. Okay, so in the next step, what we will do is we divide the difference in cost by the difference in the number of units. So if you look at the previous slide, cost 1,000, so that will be our numerator, and then the number of units, which is 2,000, will be our denominator. When we divide these two numbers, we will get the cost per unit. In this case, it's 0.50 pesos per unit. This means that for every unit that the company produces, the company would have to incur a cost amounting to 0.50. 0.50 pesos. So for the step 4, we take note of this equation. Total cost is equal to fixed cost plus variable cost. And then for the highest, what we will do is take note of the peso value from the highest number of units, which it can be found in the previous slide. Let me just flash that here. Okay, in highest number of units was 9,000. This time we will pay attention to the cost. So it's 5.7. So, okay, 5.7 equals fixed cost. Okay. Plus, to get the variable cost this time, we multiply the number of units, 9,000, which was also obtained here. Okay, so this is the portion that we will use for the variable cost. This is the number of units times the variable cost per unit that we've computed for in the previous step, which is 0.50 per unit. After doing this, you just perform algebra and you will end up with the fixed cost amounting to 1,200. Now, if you want, you can also apply it for the lowest, since we're computing for the fixed cost, and fixed cost is not really dependent on the number of units produced. Obviously, the fixed cost in the second scenario will also be 1, 2. But just to show you how it will work, for the lowest, what we'll do is we look at the peso value. So this is a peso value of the lowest based from the previous slide here. Lowest number of units was 7,000, but the cost was 4,700. So the total cost was 4,700 equals the fixed cost, which is the unknown, plus this portion here would pertain to the variable cost. So we multiply the number of units, 7,000, times the variable cost per unit, which we computed for earlier. That's 0.5 divided by, or 0.5 per unit. And we will also obtain 1,200. Now, after doing this, we can actually use the total cost. We can actually predict the total cost for producing 8,000 units. Applying the formula earlier, total cost equals fixed cost plus variable cost. Fixed cost will be 1,200, which is what we got from the previous slide. And then we multiply the number of units that we want to look into, in this case 8,000 units, times the variable cost per unit. Then we will get the total cost amounting to 5,200 pesos.